Hey guys, welcome back. In today's video, we are talking about the AMC MOAS, how we're about to rip the settlement issues, and many more in this video. First, we're taking a look at this. The AMC update. We have Spider-Man already about to hit 2, going into $3 billion. The AMC operating costs are staying the same, while the box office is bringing in billion-dollar movies, giving huge operating leverage to make a dent in the debt. So for the ones who care a lot about the AMC fundamentals, and it is an important thing, this is what we're looking at. One of the most important thing that we have seen and talked about is, of course, the operating costs. And we understand is that we are becoming more and more efficient. We are seeing the box office get even bigger. And what that means is that we're going to be seeing the increase in revenue, but also seeing the increase in the profit as well. And that's obviously a very important factor because this means a lot of things for us. Like I said, if you're someone who cares a lot about the fundamentals, the future of AMC, and not just the short term, you obviously want to look at the debt issue. And with this, we're going to be seeing AMC having more cash to obviously pay off debt. And with that, it then goes on to the next factors that people are worried about is dividends and buybacks. And once again, the things that are limiting us right now in terms of a dividend have been because of the debt. So if we are going to be seeing the debt getting paid off and we do have more and more increase in cash, we're going to be seeing a dividend. And we're also going to be looking at the potential buybacks because over the years, there has been dilution. And we've already talked about this in terms of how dilution does have a negative effect. But I do believe that the benefit has outweighed the negatives, whether it's in the short term and long term. But we are going to be seeing that potential buybacks as well. All of this is coming down to the fact of whether or not AMC has the capital to do so. And with how well we're doing currently and how we're building up a cash pile, it's becoming more and more likely to see all of these things happening. So that's why we have to understand with why the earnings and fundamentals of AMC is so important. And the big thing to know from this is that one record-breaking weekend won't trigger MOAS overnight, but multiple record-breaking releases, record quarters, improved cash flow, and debt reduction tells a much bigger story. Stay focused on the biz, not the daily price. The market will eventually have to catch up. And that's why we started off with how well AMC is doing, why the operational cost, why the box office booming is extremely important for us. Because at this point, we know that AMC is being manipulated. We know that none of the price you're seeing right now is a true reflection of where AMC should be. But that doesn't take away from the truth. That doesn't take away from what the market really stems down to, which is if a company is doing well and it has big future potentials and it continues to deliver record-breaking performances, people will invest. That company will go up. So we're not worried about in terms of the price action. And you guys can see for this week, the fact that we was down to 6% on the second day after we saw record-breaking attendance, because we know with AMC right now in terms of the growth there is. And also, this wasn't the first time we've seen record-breaking releases, and it won't be the last time either. And so as we see AMC get bigger and bigger, and we talked about dividends, we talked about buybacks, you are going to be looking at how it's going to reflect in the future. The market will have to catch up. Institutions will buy more and more like they already have been. But once the institutional interest becomes so big and they won't allow these short and market makers to get away with the manipulation anymore, that's when you're going to be seeing regulations start to really eye up AMC. And that's when we talk about with the price reflection. It isn't to say that we're not going to see it now, but of course it has been very, very difficult, especially with the dark pool that we have seen. But another thing about this is that the last time AMC finished with less volume than today was June 8th. After that, the stock proceeded to rip 57% over the next 8 trading days. And so this is what we're seeing right now. AMC for the last kind of 2 days, especially just pretty much the start of this week, has seen extremely low volume. You can see how the volume down the bottom was decreasing from the start, which was Monday, and it just decreased and decreased and decreased, and we saw a low volume on Friday as well. Now, a thing from this is that we talked about how this is off of the back of AMC having record releases. This is another case of how we are seeing how they're trying to manipulate, how they're trying to suppress the price of AMC. But every time we've seen low volume like this, every time we've seen AMC get manipulated, it has always bounced back and shown why people want to buy AMC, why AMC should be reflecting a higher price. So as we see this happen again, it does look like the data is matching up again. It does look like we are going to be seeing the same situation happen again. But also, we have to understand is that they obviously are trying to bring us down on purpose because this was off of the back of such great news. And to this, we have to understand is that just like Adam Aaron says, he who loves last loves best. And it's very important because we already knew that before the start of this week, we saw that over the weekend, AMC had another record-breaking revenue, another record-breaking attendance. And then you saw how the volume come in on Monday. You saw how the price was going up. You saw how the price went above $3, which was a very important factor. And that was the reason for why they tried to suppress us, because they couldn't afford for AMC to not only close above $3, but the momentum that it would carry. Had AMC closed above $3 at the start of this week, the momentum that would have led to the Friday would have been immense, and then most importantly, it would have allowed us to see that gamma exposure that we have always talked about, because these calls ending up in the money would give great immense pressure towards the shorts, and that's what they're afraid of. And so what they were trying to do is that they were trying to suppress AMC to make people think that AMC is not having a good time, AMC is not having great news, when we obviously know that that is not the case. There's a big reason for why all of these is happening, especially right now. And that's because of the settlement issues. We have to understand shorts and market makers had the ability to locate billions of dollars to suppress AMC for the last few years. But now what we're seeing is how it's becoming more and more difficult. You can see it looks like the risks have piled up too high, even causing the NSCC to suspend processing of large-scale ETF settlements, where essentially ETFs with a total settlement value of $15 billion or more after submission will be placed in a pending process status and will not be released for further processing until it completes the necessary review and approval steps. So this is actually a very big thing. Now, the reason why I say this is because we have to understand what some ETFs were used for. And for the ones we already know by now, a lot of ETFs, and especially some of the main ones as well, have been used to as a way of locating shares of both AMC and GME, and then to short AMC and GME. And so we know that whilst they may not try and directly short AMC, they do it so by shorting these ETFs. And with this, we've seen how XRT has seen the short percentage to be up in 300, 500, and even more percentages. Obviously, this is something that should not be possible, but they are using ETFs to short AMC and GME. And now, as we see it kind of going through this process of not being able to go through settlement until the review and approval has come through, you're going to be seeing them to lack the ability to short AMC like before. And this is why we've said they need to find the abilities to really stay away from AMC right now, to try and make people have the incentive to sell their shares, to leave AMC, because they are seeing how the ways of strategies for them to limit AMC is becoming more and more scarce. And this, I think, is a very big thing. And it just kind of talks about how settlement, how liquidity is becoming a major issue. Now, this is obviously very good for us because it allows us to understand that everything they've done to us on AMC is becoming more and more of an apparent problem, and regulations are starting to see the risk. And you can even see here in terms of the ETFs that we talked about, how they use IWM to then try and obviously short AMC. We talked about this with XRT as well. We talked about this with many, many others. But these are what we talked about with how previously they used the ETF so much that now it's become a problem. Now regulations are afraid to let them have the settlement as easy as before. They need to do the reviews, they need to allow them to actually be approved. And when they do see that billions of ETFs are used solely for the purpose of shorting AMC and shorting GME, and that they have created billions of synthetic not only for AMC but also for these ETFs, it becomes a major problem. And that's obviously what they're trying to avoid right now. The only question is, they've done this for so long, can they actually get rid of this problem? You can see reported short interest for AMC is 50 million, shares sold short in July, 430 million. Now, we've already talked about this in terms of how at the end of the day, self-reported short interest data is not something we should believe, because there's many loopholes that you can get away with. Whether you're looking at offshore, whether you're looking at the fact it's just self-reported in the first place, these are all so many methods that they can do. And one of the biggest things you can already see is the fact that we see the reported short interest of 50 million, yet the share sold short was 430 million. But also going back to what we were talking about earlier with the ETFs, these are all things that you don't have to actually report because they're not shorting AMC, but rather through ETFs to locate shares. Again, so many different methods that they are using. And it allows us to understand right now is that they're trying to create this whole image of no shorts on AMC. They're trying to create this image that they have all left. But when you dig into the truth, when you understand the data, when you've done your due diligence, you know that none of this is the case. And that's what they are obviously afraid of right now. Another thing to talk about is the options. Earlier, we talked about how they're trying to prevent AMC from going above $3 because they're afraid of the calls going in the money. And that's what we saw with this manipulation, is why we see the resistance along with the liquidity issues that they're having. But this goes hand in hand because they're facing a liquidity issue. Then they can't afford even further for AMC to go in the money. You can see for the calls in the money at $2, 161,000 calls, at $2.50, 242,000, at $3, 405,000, at $3.50, 460,000, and again at $4, 512,000. These are all calls that will go in the money when we end above these prices. You can see the effect that it can have. Now, this is the ability that apes obviously have, but this is also the abilities that AMC is having, which is showing how it is very promising. It's showing how it has such a good future. And so they can't actually allow AMC to go above $3. You can see the effect it will have for AMC when it closes above $3. 405,000 calls going in the money. Now, the pressure that will exert for AMC would easily then allow AMC to go above $3.50. Now, when AMC goes above $3.50 and it ends in the money and it closes in the money with 460,000 calls, you can understand what it will do. It will then go to $4, which has 512,000 calls ready at that price. This is the snowball effect that we have always talked about. This is also the gamma exposure that we have talked about. And you can see that AMC right now, in my opinion, is possibly one of the easiest, if not the easiest stock to see a gamma squeeze if it's not faced with manipulation. Because there is so much interest, there is so much spotlight on AMC right now, and more people are willing to be buying into these calls, wherever it's the retail, apes, or the institutions, is because they all see the potential that AMC has. And so when we talk about why they're afraid, it's because of things like this, that this is what they're trying to prevent, along with the liquidity issues that they are having. And another big thing is, if we see here from JP Morgan, margin debt is the highest it's ever been. Now, we've just talked about the ETF issues. We talked about how this is causing a settlement issue. This is causing a massive risk problem. And a lot of things is then tying into the margins because they were over leveraged on ETFs, because that's how they ultimately were able to short 500% of XRT, 800% of XRT. But a big thing about this is that margin debt is becoming more and more of an issue. And as we see it right now, these shorts are facing the problems. These shorts are seeing kind of the margin requirements really crawling up on them. It's why we talked about firms like UBS, which were required by regulations to actually increase their margin. And so a big thing then with this is that as they see the margin requirements get higher and higher, they obviously try and find ways to get away with it, to, of course, find a loophole like they always do. And one of this, and what we talked about, is that before, if they get liquidated on the positions, they have to be forced closed. And this is obviously what leads to massive short squeezes. But now what they're trying to do is by using swaps. So they hedge the short exposure with equity swaps and total return swaps to keep the book flat. Now, this may sound similar to you because recently we talked about the TRS. We talked about the AMC TRS. Now, we have to understand there are so many firms out there that own swaps of AMC. You know, wherever you're talking about Citadel, wherever you're talking about UBS, these are all companies that we have mentioned in the past before. And this is precisely the reason why. And so when we talk about how collateral falling, when we talk about the Japanese yen carry trade and how it ties in with TRS and why it's important, is because this ultimately is the way to break their short exposure in terms of how they use to keep it flat. So the moment we see all of these blow up, wherever you're looking at collateral, wherever you're looking at the swap positions, the swap baskets, you're going to be seeing how suddenly their short exposure is going to increase. Suddenly they're due for liquidation. Suddenly we're going to be seeing the margin calls, and then suddenly we're going to be seeing the squeeze. And now with everything we've mentioned, the liquidity issues, the settlement issues, Japanese yen, everything that we just mentioned, the margin debt, it's all indicating that we are going to be seeing a squeeze very, very soon, or at the very least, we are going to be seeing the explosion from these shorts to lead up to a squeeze very, very soon. As always, this is financial advice, and I'll catch you guys next time.